Well, hello, hello, hello. Good morning, good evening, good afternoon, good middle of the night, whenever it is that you're watching or listening to this. My name is Josh Thomas. I'm a mortgage broker in the state of Utah. I'm going to share some cool stuff today. I had a great conversation yesterday. I have several, seems like every day. And I'm going to go ahead and share just some of the insights from that conversation. But if you're like me, if you're ever listening to podcasts and things like that, I like to listen to them when I'm at the gym, unless I really need some intense music or something to, kind of get me over that energy level. Sometimes when I'm driving around, sometimes when I'm getting ready for the day. So if you're in any of those settings, then thank you for sharing some of your time with me. Um, I'll kind of imagine you're sitting here with me, assuming you're dressed and everything appropriately. So anyway, like I said, I'm in Utah. So everything I'm going to talk about with mortgages is going to be specific to the state of Utah. If you ever need any mortgage help and you're outside the state of Utah, I'm going to be able to probably give you some guidance, but there's going to be some limitations because every state is just a little bit different. Um, I have chosen actually for that reason to only have licenses in the state of Utah because it does vary quite a bit. So yeah, without a whole lot of extra ado, if you will, I'm going to go ahead and just kind of jump into the question. I got the phone call yesterday from somebody who had gone through a divorce and they were looking at purchasing a new home. And of course, when you go through divorce, many times people suffer from pretty significant damage to their credit. And that damage is very alarming for a lot of people. However, oftentimes, if they can ever agree on a price that they sell their house at, oftentimes have a house already. And then when they come out of the divorce, they're selling that property a lot of the times, and they'll have some of that equity that they're going to be able to allow and use as a down payment. And that also was an important part of this conversation. And so I'm going to go ahead and share that as well. I'm trying to think of, well, I'll just kind of take it as it goes. And so, anyway, hopefully this time is enjoyable for you. And I may invite other guests as I continue to go through this because I love talking with realtors, financial planners, estate planners. They're all a very intricate part of my business with my clientele. And I love my business. I've been doing this for 22 years. That puts me in the eras of 2008, 9, and 10 in the Great Recession. And boy, oh boy, can I tell stories, and probably will at some point in this podcast. Not today. I was also here in the pandemic, January, February, March of 2020 when there was rumors, and then 2020, 2021, and all kinds of exciting and amazing things that happened there. I was also here in 2022 when interest rates went up and my phone stopped ringing. That was an interesting experience. Very, very challenging for the mortgage market. Don't feel too bad for us because the mortgage industry was busting at the seams and everybody was making more money than they ever made in the years 2020 and 2021 and even 2019 for a lot of folks. But 2022 was about a 70% pullback in the industry. So if you can imagine the company you work for, the organization you work for, suddenly doing 70% less, and the staff that they would no longer need, and how the impact that would, how far reaching that impact would be. Anyway, I've been here for all of that. I was here in 2003. That's when I started. So in any case, in that length of time, I've had lots and lots of stories. So this particular story, let's go back to the point. So she's concerned about her credit. That's her biggest concern. But her down payment's going to be, she's going to receive through the sale approximately, I think it was $140,000. It's a little TBD. Obviously, the house isn't sold yet, and all of that is still kind of coming together. But attorney fees from the divorce and some bad debt that's kind of come through the divorce that needs to be paid off. And so we're still determining how much she'll have, but it's a really important point so that she does have about 140. And here in Utah, and we're in the Salt Lake County area. In that area, the median house price is it's like 550. She's probably going to be looking in the 450 to 550 range, I would guess, somewhere in that ballpark. And so a down payment. If we're looking at an FHA down payment, for example, FHA requires a 3.5% down. Of course, there's closing costs and other things, and for legal regulations, I have to post and share APRs and down payments and monthly payments and all these things that come along when the lender talks about these things. But FHA's requirement is a 3.5% down of the purchase price. So if it's a $500,000 price, that's about 17.5 that needs to come out of pocket for the down payment. But if she has 120, 140, obviously that's a lot extra. When somebody talks to me about having credit concerns are real, right? And so if there's any challenges with credit, FHA is often kind of it's a great place. The FHA rates are fantastic. They do have mortgage insurance, but honestly, their mortgage insurance is pretty dang competitive with conventional. So honestly, a lot of great credit people are also using FHA. It just has different guidelines than Fannie Mae, Freddie Mac, and FHA, or the others. In fact, why don't I diverge for a second, since this is kind of a long form type of thing. It's usually really helpful for folks to recognize that there's 5 main agencies in the United States in the mortgage market. So you have FHA, I've been talking about. They're probably the best recognized, but there's Fannie Mae and Freddie Mac as well. And they're both conventional loans. If you hear that phrase, that's usually what they're referencing, is either Fannie Mae or Freddie Mac. And then USDA and VA both have housing departments as well. And these housing departments, these 5 agencies are responsible for about 95% of all the loans done in the United States. And so when somebody comes in the door, I'm going to be listening to what they're saying and trying to figure out which direction they're going to go. And each one of these agencies have rule books about 1,000 pages or bigger. And they like to update them all the time. So if you're looking for a career change, and that sounds exciting to be able to keep track of 5,000 changing pages, come on in. It's a great industry. It's been a great business. But an AI has obviously helped in large measure for that. Helping everybody make more sense of it. But we are getting an interruption. Can we do that on a live broadcast? That's kind of fun. I may come back in. Let's see. Anyway, long story short, let's go ahead and talk about her. We'll see about how this interruption goes. That is funny. In any case, 120,000, if she's got that to put down. FHA has this fun parameter. If your credit score is under a 580 and goes down to a 500, you can actually put as little as 10% down. And so if you put 10% down, then you can go all the way to a 500 credit score. So 500, I've joked around for a long time with a lot of folks. When you're doing a mortgage and I pull your credit and it's a 500 score, you almost have to try pretty dang hard for that. It almost takes as much effort to have a 500 score, or I say a 400 score, as it does an 800 score, quite frankly. And so if you do have a 500 score, what I'm telling you is that's pretty bad, and you probably know it. You're probably actively late on several things. You probably have several recent active collections, maybe a few judgments. Judgments don't impact credit scores quite as much anymore. Because there was a law a few years back that passed that kind of removed judgments from the credit in general. But judgments are still real. So don't mess around just because you don't see them on your credit. But you probably are going to know if you have a 500 score, a sub 500 score. FHA goes down to a 500 score. Now, most banks then have to kind of endorse that loan. Like, FHA will buy it as long as you follow certain rules. And the lower it gets, closer to 500, the more strings kind of attached to it. But if you've got a 580 score, for example, most every bank that I work with is going to purchase that loan. If you've got a 550 score, I only have a handful of banks that'll purchase that loan, even though FHA will purchase the loan from them. But sub 550, we have just 1 or 2. And so the strings gets more and more challenging. Obviously, the rate's going to go up a little bit. But like I said, if you had a 500 score, you're probably going to know it. You're going to know you have terrible credit, and you're going to know that you're currently late on stuff. Most likely that's the situation. So she's telling me that she thinks her credit's pretty beat up. There's lots of stuff that's happened from the debts that weren't supposed to be hers, that weren't being paid. But she was signed on, and there's a whole, yeah, maybe I should actually get into that. I didn't really prepare for that for this call, but um, I'm going to look for another opportunity to share that. There's this whole little um, list that I give. In fact, if this is something you're listening to and you would like a copy of this list, it's a list that I give to people when a divorce is pending. And it's not to facilitate their divorce or anything. I actually hope that people figure things out and work it out. But when a divorce is imminent, it's the reality is that both parties grow irrational frequently. And when you're irrational, it means that what you're saying and doing doesn't make sense. You'll literally shoot yourself. Well, not literally. Hopefully, you're not literally going to shoot yourself in the foot, but you literally are going to harm yourself when you're irrational. You're going to do things that make no sense, and you're going to go down with it. And so when people get involved in divorce and it gets irrational like that, it can cause some messes that take years to recover from. So I get it when she tells me that she's got some late payments and things. I totally get that, right? And there's always two sides to every coin. Anyway, put in the comments if you're listening to this and you want to see that list. Just put in your comments that reach out and we'll connect and get you a copy of that. But yeah, it's kind of these are the things you should do if you're going to go through a divorce and to protect your credit. Okay, outside of that, let's going back. So she's talking about this 500 credit score and or something like that. And I explained to her that if she's at a 580 or higher, she only needs a 3.5% down. If she goes from 3.5 to, or excuse me, a 580 to a 500, we are going to need 10% down. But even 10% of a $500,000 house is 50 grand. That still leaves her at least $70,000 to $90,000. And then I kind of took a segue in this conversation where I was like, okay, I need to interrupt the course of this conversation for a minute. And this is part of why I wanted to put today's broadcast together. Is when you are buying a house and you have X number of dollars you can put down, it does not always make sense to put all of it down. So if you're going to sell a house you've owned before, a lot of people ask me about taxes. And if you don't know this, the taxes aren't calculated by how much cash you receive in hand. The taxes are calculated in rough measure. I'm not a CPA. Consult with your CPA to have a exact desire or understanding of this. But when you calculate your taxes on a property, first off, most of us have a primary residence exclusion. I think it's is it 157 or 179? IRS publication 157, I think. It's called the primary residence exclusion. And if you're a single person, you have a $250,000 gain that you can receive on your primary residence from the time that you bought it to the time that you sold it. And as long as you've got a gain of $250,000 or less, then you will receive an exclusion that wipes out that gain. If you're married, it's a $500,000 exclusion. And just to be clear, that number hasn't been reset in over 30 years. And it is one of the many things that Congress is discussing. And then people keep bringing up is to actually raise that limit even higher, potentially take no ceiling, or at least peg it to inflation or something like that. Because a lot of people are now invoking that tax. A lot of people have owned their homes for 20 years and they bought them for $150,000 and they're selling them now for $700,000, $800,000. And obviously they've gained a lot more than that 250 or 500. So in any case, kind of going back to the point. So when you sell a property and you have all that money, you don't necessarily need to put all of it down. There's no tax built on how much money you save in your hand. And a lot of people find that it's very advantageous for them to consolidate all their debts at that point, pay them all off. Now, some debts are better than others. Some debts, like credit cards, are often ranging between 15% and all the way up to over 30% right now. I've definitely seen a lot of people with higher rates like that. And if you got that, I would probably very likely encourage you to use some of your proceeds to actually pay those debts off. But car loans, if you've got one of these specials, it's a 0% or 2% or something really low like that, I might discourage paying that off and actually just writing that out full term. Um, let's see what else. So yeah, so when I was talking to her, I just thought, I'm going to take a second. I'm going to talk to you about how much you should put down. Because it doesn't sound like she has to put all of it down. Now, most people want to put a lot of it down because they want to have a lower monthly payment. And that makes sense. Who wants a big monthly payment? But let's kind of follow this down in a second. So I'm going to step aside now, just like I did in our conversation yesterday. So Josh Thomas, mortgage guy, right? He's been doing this for 22 years. Right after I got into the business, I started getting exposed to this stuff called mortgage planning. And mortgage planning was something being employed by a lot of baby boomers at that stage, where they'd been making a lot of money and they were getting aggressive at paying their houses off, doing 15-year mortgages and biweekly payments, and velocity banking, where you're using a HELOC to rapidly repay mortgage balances. And there's 100 different ways you can do it. Throw an extra 100 payments, $100 a month on your payment, or like I said, a biweekly. Just 100 different ways to slice it. But all of it basically falls under the same umbrella that you are paying off your mortgage faster than required. And if you're going to do that, you need to recognize that that doesn't always make sense. The goal is twofold. From what I've been able to observe from others, the goal is twofold. Number one, I want to pay my house off sooner. But I think most of us in the back of our mind recognize that's literally like decade, 2 decades, 3 decades away. It's a long time to be making plans today for. A second goal, and I think this one may be the forefront, is to save money. If I can pay the extra $100 a month, or if I can make an extra payment a year through this biweekly payment plan, I'm going to effectively remove several years of repayment term. So instead of a 30-year mortgage, maybe I end up with a 23-year mortgage. And in a 23-year mortgage, maybe I don't have as much interest I'm going to spend, right? Because I paid it off. And that's accurate. It is 100% true. However, people get really confused with this amortization idea. If I pay an extra $100 a month, I save $30,000 or $50,000. And they think that that means they're paying an extra $50,000 on their existing balance, which then makes them think, oh, my interest rate's not really a 6%. It's really more like an 8%, or more like a 50% or something like that. That's kind of, I think, some of the thinking that goes through people's minds. That is a fallacy. That is 100% error. You need to understand that if you're paying extra on a mortgage and you're saving this, we'll call it $50,000, that $50,000 is saved. That much is saved because you've had the loan for 23 years. If you took the same exact money you put in the mortgage to save the 50 grand, and you just put it into some kind of retirement account, like a mutual fund or 401k, an IRA, whatever your financial advisor recommends really for retirement planning, you put it in there, you're most likely going to average a higher rate of return anyway. But let's just say you have the exact same rate of return as whatever your mortgage rate is. So let's say it's 6% mortgage, 6% your average rate of return that you get in that investment. If you put the same exact money, not in your mortgage, but into that retirement account, you will find that you will save all of the exact same money, the same $50,000, and even more. And the reason you'll save even more is because the investment's going to offer compounded interest. Okay? So if you're taking the exact same dollars and you're putting it over here and you're earning even more, then why are you putting it over here in the mortgage to begin with? That doesn't make any sense. And the reason it doesn't make any sense is because people are confused. And that's part of the whole point of this video, right? So, point number one, instead of paying anything extra on your mortgage, don't, and put it into your retirement account instead. And you will rapidly grow the money, more rapidly grow the money that will then enable you. Because if you're growing it in your retirement account this whole time, doesn't it stand to reason that around year 23, you could cut a check from your retirement account into your mortgage and thereby pay the mortgage balance off in full? And the answer is yes, it does work that way. And then if you go back to your retirement account and you look, you'll notice there's more money in there still, even though you cut the check, even though you paid the mortgage off on schedule to your original idea, you still have more money left over, which stands to reason you could actually pay it off earlier. So this is what I'm trying to say, is it's actually a faster and arguably a safer way to pay off your house than it is putting anything extra into your mortgage. Does that make sense? If not, message me. Yeah, send me a comment or something like that. Let's elaborate. And I'm happy to come in later on and elaborate in these messages on further episodes. But if that makes sense, then this next point will really come home for you as well. And that is, if that's going to be a faster way to pay off your house and a safer way because you have the money in your control instead of having to refinance or sell to get it out, if you understand that makes sense, then doesn't it also make sense to not put anything extra down when you're buying a house, but to take the biggest longest term mortgage you can? Doesn't that make more sense? And then to just grow the money as fast as you can and take the down payment money and put it over here instead. Now, I'm not a financial planner. I don't have the license for that. And so it's important that you do this responsibly. And not everybody's ready for this. And I support that. In fact, if you're a client coming to me today and this is the first time you'd ever heard of this, I would tell you, and she's no exception. I told her the same thing. Look, I'm probably going to have you put all of it down, just to be clear, because you're not prepared, right? You're not ready for that experience. You don't have the financial planner that you know and trust. You don't have the experience as an investor, so it is safer for you for now. But I'm going to encourage you to learn and to start practicing. And so instead of paying extra on the mortgage, do the down payment. But instead of paying anything extra, put that into your retirement account. Start growing that, and as the years go by, you'll become better. And maybe at that point, we take your down payment back out, if that makes any sense. Um, so that's kind of I think that's the main stuff that I really wanted to cover. I kind of circled back with her and basically just shared those concepts with her. And so, does it make sense to put all that money down on your house? Maybe not. Do you understand that investing might actually be a faster, safer path for you? And then third is, how bad can your credit be, and you can still get approved? So there's some different really good points in there, and hopefully that helps. Go ahead and comment, share with me any thoughts or other questions that you'd like to talk about. I would love to hear what big aha moments you've had in your life. I'm assuming we might have a few baby boomers listen to this, and as that happens, I'm sure that you guys have heard some of these ideas before. Pro or against, right? Are you in favor of the 15-year mortgages and you think my stuff's crazy? I wish I could call it my stuff. It was around before I ever got in this business, and I've watched it practiced for 20 plus years, but it is new and they are valuable strategies, but you need to learn them. And then once we've learned them, we need to learn how to employ them. They're different. So anyway, thanks for tuning in if you did. And we'll probably make future podcasts a little bit longer, but didn't want to wear out my welcome this time. So anyway, thanks for spending your time. And if you did this in 2 time, that's actually pretty short. Whenever I'm listening to podcasts, I usually, go at least 1.25, but sometimes 1.5. And then when I start talking to people in real life, I realize I'm kind of in a hurry and I want them to say what they're saying faster or something like that. So hopefully you guys are taking advantage of the timestamp, and maybe I sound more like a chipmunk because you listen to it so fast. Anyway, I don't know, but hope you're doing great, and I hope this finds you in great health. But reach out with any thoughts, questions, comments. Just enrich the community. Share what you know, and or ask your questions that you'd like us to elaborate on. And have a great day.